Welcome to my channel. I'm Scott, and in this video, I'm going to walk you through the process of valuing l.e.g stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. l.e.g is a residential real estate company. The company is headquartered in Dusseldorf, Germany, and was founded in 1970. It went public in 2013 and currently trades on the Deutsche Börse Xetra stock exchange. It also trades in the US on the OTC. The ticker is l.e.g.if. It is Germany's third largest residential real estate company. It has 145,000 apartments in its portfolio. Its focus is on affordable living. The average rent is 380 euros per month, which is equivalent to 455 US. 92% of its units are in North Rhine-Westphalia. That section of Germany is 20% of its total population, and it makes up 22% of its GDP. 1 out of 4 of its apartments are rent stabilized, and those tenants are supported by the state. We're going to look at the ticker that trades on the Xetra, which is a German stock exchange, so all the numbers in this video are in euros. Let's get started with the model. This is a mid-cap company, 8.5 billion euro market cap. They're trading at 119 a share, and they have 72 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have positive and growing free cash flow each year. It looks really good because it's positive and consistent. The easiest way to value a company is when the company has positive and consistent numbers. Net income is the profit and loss on the income statement. That grew from 800 million to 1.4 billion. Revenue is the sales for the company. That dropped a lot from 2017 to 2018, then jumped way up in 2019 and jumped again in 2020 to 2.1 billion, their highest ever. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example is the cost of labor. The difference between those two numbers is their gross profit, which was the highest in 2020. Below that is operating expenses. Examples are marketing and depreciation. Then below that is operating income, which was the highest in 2020. Then we have the interest they pay in their debt. They paid $102 million of interest, which was a lot lower than 2019. It was the lowest amount they paid in the past 4 years. Then your pre-tax income, your taxes, and the bottom line of the income statement is their net income. And they had their highest net income in 2020. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus capex gives you your free cash flow. And they did have their highest free cash flow in 2020 at 310 million, a little higher than 2019. It does look good when you invest in a company with positive free cash flow, but they pay over 500 million euros of dividends, so they need to take out debt to fund their dividend payment. As you can see, they took out nearly $1 billion of debt in 2020. They paid down 200 million. So they increased their debt load 800 million in 2020. They increased it 700 million in 2019, 300 million in 2018, and 500 million in 2017. They also added 270 million of capital stock in 2020. When a company adds capital stock, that increases the shares outstanding, making your shares less valuable. Let's look at the capital structure. 7.4 billion of equity, 5.9 billion of debt. They're 56% equity, 44% debt. And their WACC is 7.5%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 8.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of 8 billion euros. We divide that by 72 million shares. And we get a calculated stock price of 111. They're trading at 119, so they're trading at a 7% premium. It's a sell according to the model. Simply Wall Street is a lot lower than me. They're at 90 euros, so they're saying the stock is 32% overvalued. 19 analysts priced this stock, and the average price was 111. The low was 85, the high was 130. This is the stock price the last 5 years, so it looks like it's done really well. It did take a big dip in March of last year when the market crashed, but it came right back up well past its all-time highs. It looks like the stock price dropped about 10% at one point. It's come up a little bit, but it's trading about 10 or 15 euros lower than its all-time high. They have a really low beta, 0.37, so the stock doesn't move too much. It's much less volatile than the market. The stock has gone up 13% in the past 52 weeks, while the S&P 500 went up 48%. The 52-week low was 102, the high was 129. And the stock is trading above its 50-day and 200-day moving average. About 150,000 shares are traded each day on this stock. Pretty much all the shares outstanding are on float, and 63% of the shares are held by institutions. If you include dividends, this stock has gone up 19% in the past year, which is worse than its industry of 27% and the market of 48%. In the past 3 years, this stock has outperformed its industry and the market. In the past 5 years, this stock has gone up 74%, its industry 75%, and the market 55%. Their annual earnings in the past 5 years grew 21%, its industry grew 12%, and the market grew 7%. In the last year, their earnings grew 66%, its industry decreased 8%, and the market decreased 1%. Analysts are forecasting their earnings to decrease 16%, its industry to decrease 7%, and the market to increase 21%. Analysts are forecasting their revenue to decrease 7%, its industry 16% decrease, and the market to increase 6%. The top shareholder is MFS Investments at 10.5%, then BlackRock, Vanguard, BNPP, and the last one is Flossbach von Storch. Let's look at their financial ratios. The average PE in the market is 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 6.3, so investors are paying $6.30 for $1 of earnings. That's a really good PE ratio. Their price to sales is 4.1, which is between the median and average. Price to book is 1.2, which is much better than the median and average. Their return on invested capital is 9.3%, and their WACC is 7.5%. So they have excess cash flow of 1.8% every dollar they invest into their company. Interest coverage ratio is 15.0, so they can easily cover their interest payments. ROE is 18.5%. That's a really good ROE. Their current ratio is 0.5, so they can only cover half their current liabilities with their current assets. And their current assets are mostly cash of $333 million. They do seem to be undercapitalized. That's why they're taking out so much debt. They generated 300 million euro of free cash flow. They have negative 430 million of working capital and over $500 million of dividend payments. So they're short $639 million. The best way to look at ratios is to compare them to companies in the same industry. I've done videos on Brookfield Property Partners and CBRE, both in the same industry as l.e.g. And if l.e.g. has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're better in PE. They're worse in price to sales, even though they have a good ratio. They're a little better in price to book. They have a weak current ratio. Brookfield is even worse. Their ROE is pretty good. They're a little higher than average in debt. When you convert all the market caps to euros, they're the smallest company. And their dividend payment is a lot lower than Brookfield, and CBRE doesn't pay a dividend. So to summarize, I have them trading at a 7% premium. This company has been around a long time. They do play an integral role in Germany because they provide housing to a lot of people. But they seem to be short every year in cash flow, so they need to fix that. If they don't improve their cash flow situation, they may need to cut their dividend so they don't have to keep taking out debt to fund their dividend and fund their operations. I rank their free cash flow 7 out of 10, their revenue 7 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.